So every insurance company, based on the nature of the insurance policy, based on the risk factors, will decide upon providing you a premium amount that is being collected from the various policy holders would be put across into different investment instruments altogether to generate a good amount of returns. Good morning and welcome to the Session 6, Unit 4, Principles and Practice of General Insurance. Now, in that session, we are going to talk about the premium rating, which is very, very important in terms of insurance. Now, moving further, what is a premium rating? An insurance premium is the amount of money an individual or business will pay for an insurance policy. Now, insurance premiums are paid for policies that cover healthcare, auto, home, and life insurance. All of us know that whenever we talk about insurance, the first word that comes to the top of our mind is the word called as premium. How much premium do you pay to cover yourself? So every insurance company, based on the nature of the insurance policy, based on the risk factors, will decide upon providing you a premium. Now that premium has to be paid monthly, annually, quarterly, or half-yearly. It depends upon the convenience of the individual or the business. But then the insurance policy has a very clear-cut terms and condition. They tell it that every time when you are looking in for a policy, you need to first understand what is the coverage factor in that policy and why an X amount of money is going to be charged as a premium. Premium is not something that you just blindly pay because you need a coverage. Premium is something that you pay because you have to be protected at all point of time. So that is why premium comes into picture. Now, moving further, understanding the insurance premium. When you sign up for an insurance policy, your insurer will charge you the premium, and this is the amount you are going to pay. So the insurance agent will first call up and tell you, so while signing up the document, these are all the factors that you need to read and understand. Followed by, he will also tell you that how much amount is going to be charged as a premium for the insurance. Now, as a person taking insurance, you should be aware about the title of the policy, the contents of the policy, and for what reason the policy is being taken, and what are all the factors that are going to be covered by that insurance. Followed by, the policy holders may choose a number of options for paying their insurance premium. With the advent of financial technology coming into play with a lot of UPI, online payment, and several convenient methods, now it is up to the person to choose the kind of payment, the method of payment rather, I would like to say. So the insurance company gives the option to the person saying that you can make your payment on a monthly, annual, or half-yearly, quarterly basis at your own convenience. So that's why the policy holders will have the options to choose from. Some insurance holders will start, that is the insurers, allow the policy holders to pay insurance premium in installments, that is in monthly or semi-annually, while others may require an upfront payment in full before any coverage starts. Now, this is something quite interesting for us to know, because we are talking about a general insurance factor here. Some of the insurance company go back and tell their people very clearly that please do make the payment in full for the coverage to begin, and certain insurance companies might be flexible enough in providing you the option. This depends upon the nature of the insurance cover that you have taken and the policy that you hold altogether. followed by insurance premiums may increase after the policy period ends. So this is where you need to understand a very, very important concept. Why? Because insurance premiums may increase after the policy period ends. So once the policy is over, now when you want to renew your insurance, that means there will be an increase in the premium. Why is this coming into picture? This is very important for all of us to know, because sometimes there might be chances as you start growing older, in the sense the age of the property starts growing older and older, the insurance companies need to provide more money, more coverage for that, which means the premium also will start going up. So in that category, what happens here is that the insurance companies will charge you a hefty premium. Even in the case of life insurance, if you see, as the person gets older and older, the value of the insurance premium will also start going up, because we believe that as we become older, we are tend to become or prone to become prone to diseases or any kind of malfunctions altogether. So in that similar manner, for a property like a house, or when we are talking about auto insurance, or when we are talking about burglary insurance or any kind of insurance, as the age of the property becomes on the higher side, the value of the premium will also start going up. Now with that, the insurer may increase the premium claims during the previous period if the risk associated with the offering is of a particular type of insurance increases, or if the cost of providing the coverage also increases. So as you start going up, now the chances are there that once if you claim any amount from the insurance company, then automatically the insurance coverage or the claim might be on the higher side altogether. So what we typically tend to do here is that we would tend to ask the people, or we would tend to tell them very clearly that if you have to go in for a higher coverage, you have to pay up extra amount as a premium. Now, if the insurance company feels that the claim or the value that's going to be claimed across by that insured person is on the higher side, or the factors of risk are associated are even more higher, then automatically the premium value will also go up and the insurance cost policy will also go up. So they will typically try to first assess the risk situation that is associated with the insured property. Now, the next thing is, how are premiums used? Now, premiums paid to them by the customers and policy holders in order to cover the liabilities that are associated with the policies they underwrite. So who are the people who actually determine the value of the policy? It is none other than the underwriters themselves. So what they typically tend to do, they will first find out the insurance premium value. They will first decide on how much premium that individual person has to pay, and based on that, the policy will be subscribed and the premium will be rated. Following which, they may also invest the premium that is collected from the policy holders to generate higher returns altogether. Now, this can offset some of the cost of providing insurance coverage and help the insurer to keep their prices competitive. Very, very important for us. So once the insurance company starts collecting crores of money as premium from their millions of policy holder, they will put that money under a safe deposit, or they will invest it in the market with a secured returns, so that for the insurance company, they have some backup, and at any given point of time, if they have to cover some loss or some risk factor altogether, the insurer does not have to worry, because he would have enough cash or enough backup to hold up to that situation altogether. So definitely the premium amount that is being collected from the various policy holders would be put across into different investment instruments altogether to generate a good amount of returns. Followed by the future of insurance premium prices. Now, this is very, very important. Why? Because insurance companies generally employ professionals known as actuaries who will actually determine the risk level and the premium prices given for an insurance policy. That's quite interesting for all of us to know. Why? Because insurance companies will generally employ professionals and they are known as actuaries. So the actuaries will actually determine the risk level and the premium prices for a given insurance policy. So they will say, this is the insurance amount, this much you need to pay. These are the factors under which we are working. So automatically you will be able to understand this factor clearly, stating that suppose I am going to take an insurance today and that's going to be for my car. So they will first associate the life of the car, whether it's a brand new used car, what is the rating, what are the factors. Based on that, the actuary will decide the value of the premium. So that is how they would first try to understand the value and take it forward altogether. The emergence of sophisticated algorithms and artificial intelligence is fundamentally changing now how the insurance is priced and sold. So that is very, very important for all of us to understand, because that is how the actuaries, the insurance companies are working together in order to create a different factors, a different growth segmentations altogether. Plus, what is happening these days is that we are using a huge amount of data analysis. That's what we are calling as data mining. We are using artificial intelligence systems. We are using the business intelligence concept. All these things in order to derive the value of the premium. So premiums do not have to be just calculated using an Excel sheet, or do not have to be calculated with doing some manual calculations. There are a lot of factors which are being considered by the system. Now the system will work in accordance to that and generate the actual value of the premium that has to be told, and based on that, the insurance will be priced and sold to the policy holders. Followed by predicting the cycle. Now this is very, very important. Why? Because premium rating indices show that market premium rate movements can be used to monitor the position of the insurance cycle. Now that's quite interesting for all of us to know, because you want to know, you want to understand the projected rate, how it works and where things are moving for you. So these projected rate will actually help you to understand, estimate the future movements altogether. So now what happens is that people will start understanding, people will start now calculating all those factors. They will start seeing that where we can make a movement, how we can make a change factor come all together. So all the calculations can be understood, can be predicted by seeing that what is the position of the insurance, what is the level at which the market is undergoing, any changes in the economic cycle, any changes in the healthcare, in the environment, any kind of risk factors. All those things are being understood, which is being used in terms of predicting the cycle, the value of the insurance. Analyzing the returns. The rating indices have been used as a part of analysis for change of any company or for the market results. And this is helpful because they will be able to identify the change in result that has been caused by the rating movements. So what happens is that when the insurance companies seek to invest in companies or try to understand the values of the company, the rating instruments will actually tell what is the performance level of the company, how much they have been able to earn, what are all the factors, is the company holding steady, is it secure enough to invest, are their assets in good position, has the provisions gone up, have there been any changes with the NPA or the net non-performing assets, all factors. All these things would be helpful in the rating agencies done so that you can analyze the returns altogether. Now, this may be also used retrospectively to analyze the result, and on a positive basis, insurance companies are also masters of investment. So they seek to invest in so many other companies in the market where they see good returns coming back in future. So that's why I would always say that this is one of the most optimum method for us in order to invest and take it forward. Now, the dynamic financial analysis, internal and external indices have also been put as an input factor for the dynamic financial analysis. So definitely, this is one of the biggest structure help that we have been talking about. Potentially, though it might be very complex, including some of the measure factors that we have taken that is used for the competitiveness of the company, which keeps varying over time, which may also be in terms of feeding to assume the mixed factors of the business, time lapse, what are all the new business models, how the company is changing according to the time, what are all the different change, what are all the different scenarios that is helping the company to grow, is the company diversifying themselves for new models. All these kind of factors can be understood and analyzed using the dynamic financial analysis. Now, the reasonableness testing, which is also coming up. Why? Because even if alternative methods are used to carrying out the reserve of the items that are being mentioned, why they are being used, what are all the different factors, these simple models of rating indices may be useful for the reasonableness and analysis of the test factor. So this is very, very important in terms of analysis. This is very, very important in terms of understanding the value, the reasoning out, how things have to move, how things have to take it forward. So all these factors are coming out in a big way in terms of understanding the industry and taking it forward altogether. Now, with that, I come to the end of this particular session. I hope and believe that all the information shared through this session would be of a great help and would be of a great resource to you. In the upcoming sessions, we shall be talking about the premium loading and the other factors. But until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me today on this wonderful session.